This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker. I'm here with Manus Clancy. Welcome to this week's episode. I hope everyone had an enjoyable 4th of July weekend and saw some good fireworks. Manus, pretty interesting week for the market. We talked last week in our predictions episode about pretty strong case for bullishness in the second half around lower oil prices, better inflation prints, the hope that a peace deal was close in the Mideast. But this week, I think, reminded us that the market can be walking a kind of a narrow path. And it feels like that childhood game that we used to play called Chutes and Ladders, because the 10-year Treasury just jumped back above 4.5%. And only a week or two ago, we were building a pretty optimistic second half story around lower oil prices, cooler inflation, the 10-year drifting back to the low fours. And here we are. And then in the equities market, the AI trade flipped from a rally to chipwreck almost overnight. So, Manus, what's your take on what's been happening this week?
Well, I think this is my week to eat a little crow, you might say. I have been very forthcoming in my bullishness about where we were going. My thesis had been for quite some time that the peace would hold. I didn't have enormous confidence in that, but I did believe that the White House had an incentive to call it a day in the Middle East. And I thought that that would trigger a waterfall of good news, that we would see Treasury yields come down, we would see borrowing costs come down, we would see an uptick in enthusiasm for commercial real estate, and we'd see another leg up in the equity markets, along with, of course, falling gas prices and so forth. And at least as of this week, that entire narrative is fraying, if not collapsing. What we saw this week was the renewal of really open warfare in Iran. The president is not shying away in his words or his deeds, that there's open bombing in Iran, and oil prices have spiked again today, and the markets are jittery. We saw the 10-year a few minutes ago up to 4.56%. That's up 17 basis points week over week. So it has been a very, very sobering week for the markets. You pointed out equities as well. An enormous sell-off yesterday, especially among chip names. You took the term right off CNBC, which was chipwreck. We saw the big tech names sell off dramatically on Tuesday. They're also down bigly on Wednesday. They have since rebounded somewhat today and are flat in the afternoon. But it hasn't been a good weekend anyway for the markets. And there's really nothing really redeeming about the news headlines over the last few days.
It's just another example of what a difference a week can make. Folks who wrote maybe bullish forecasts a week ago might be pulling out the proverbial erasers to at least create some alternative scenarios around it based on what's happening.
Well, one thing we should mention is late last week, shortly after we recorded, we did get that rare Thursday jobs report, and that was underwhelming. The expectations themselves were underwhelming. We know that in an expanding U.S. economy, we like to see 250,000 new jobs created every month. We have been far from that for a long time, for several years now. But we did get some positive upticks for the last couple of months where the numbers were surprisingly spry on a curve, right? We were nowhere near that 250,000 jobs number, but we were 125, 150, which was better than expectations. I think that got people feeling better about the jobs market. Thursday's number, a big disappointment, 60,000 jobs added last month, which was really shockingly low. But the big surprise out of that for me, Dianne, was that normally a print like that triggers a big dip in Treasury yields, that people say, okay, the pressure's off the Fed, the economy is slowing, we can table any talk of rate hikes because the jobs market is a little bit underwhelming right now. And instead, what we saw was this noticeable uptick in Treasury yields. So that was a little bit surprising, but it added to what was really a disappointing week, at least on the financial side.
Yeah, for sure. And you hit on two things that I want to really lean into here. The first is that certainly one impact of the jobs report was it reinforces the idea that the labor market is cooling, and it certainly quiets the chatter that the Fed is about to hike rates this summer. I don't think that's kind of a broad expectation right now. And then the second thing that I read was, although the report was, to use your word, underwhelming, there are more industries that are adding jobs than cutting them. And construction hiring in particular was called out as improving, and consumer spending remains positive. So, there was some good news if you kind of peel back the layers of the onion there. But you're right, overall, it's still a very, very challenging labor market, which has implications, obviously, not just for the economy, but for commercial real estate.
I also think that this AI trade had gotten frothy for a while, and it has turned from frothy to tired very quickly. When you look at shares of something like Micron, for example, where shares were up, I think, 300% over the last 6 months or so, and they were not alone. SanDisk was in the same category. AMD was in the same category. There were several names like this that had seen melt-ups that created enormous wealth for people, no doubt about it. I think Micron, over the last week or so, went from, and I'm kind of guessing here a little bit, it's kind of my loose memory, but it's from about a share price of about $12.50 to under 900. So it's lost about a quarter to a third of its value in short order. And I think we've gone from rock solid enthusiasm to doom and gloom in record time in that part of the market.
You're right. And so many wild swings in the market. And that's a great example. And it's, I think about commercial real estate and the AI boom and all of the just enormous investment dollars that are going into data center. But here in the equities market, the headlines are all over the place and swinging wildly, as you said. The market, I think, is starting to kind of separate what long-term AI demand is, versus short-term valuation excess, and whether, things have gotten too frothy. And it's like the AI trade. I mean, they need the equities market, obviously, but it's become the market's engine and also its kind of greatest pressure point. So,
Well, I want to stick on this for just a little bit longer for a couple of reasons. The first is that one of the triggers for this sell-off was news that I believe it was Amazon was going to start trying to sell excess computing capacity. And for the last 6 months, the headline had been, people cannot get enough computing capacity. We need more data centers. Every one of these firms lining up trillions of dollars for land, data center development, tapping the capital markets. And now all of a sudden you have one of them saying, maybe we have computing power to burn. Maybe we could sell some off. That, I think, really set the market on fire. We also saw a headline with, I believe it was BlackRock, selling off an enormous stake in 3 data centers in Northern Virginia. They were a 50% stakeholder in 3 properties in Northern Virginia that had an aggregate value of over $3 billion. And they moved out of that particular trade. So you have 2 particular large names bringing up questions right now about maybe this is getting overdeveloped very quickly, and maybe it's time to start peeling back. Let me get your thoughts there first, and I'll move on to a derivative topic on the same subject.
well, isn't that kind of the first stage of a market that's gotten frothy, is that more and more people start asking questions and thinking, okay, has this market peaked? Have things maxed out? And you don't want to be the last one there, holding the cards. I do think the volatility is probably something that will be with us at least until there's more clarity in terms of whether valuations have gotten ahead of the fundamentals. But I don't think for commercial real estate, I don't think that the data center story's over for sure. But I agree. I think that Blackstone story raised a lot of eyebrows.
And I'll turn briefly to the capital markets and its impact. Love to get your thoughts here as well. For about a year, we have seen really tight lending spreads across the entire capital markets CRE continuum, that risk premiums have been really, really tight, which has helped keep a lid on borrowing costs. We saw Treasury yields move up considerably over the last year or so, but we haven't seen the big widening that may have come with higher rates, right? We've seen recent lows that have held for a long period of time. But Barron's had an article the other day which talked about weakness in the bond market for those that have raised money through the bond markets for data centers. And they were saying that a lot of these data centers were financed through the bond markets, and traders are finding out people don't love these bonds. They've had to widen spreads on these bonds by 25 basis points or more just to get them off their books. And I wonder if that will spread throughout the capital markets. Markets tend to have a certain contour from segment to segment to segment. And if we do see weakness in the data center bond market, will that gravitational pull impact CRE spreads, CMBS spreads, pull spreads further north, and make borrowing costs even higher than they are today? Something to watch.
I'm not loving that scenario, Manus, but that's the first I heard of that. I did not see that Barron's article.
I'll have to dig it up again. I'm still, such a hard copy guy.
Yeah.
The term boomer is thrown at me way too often by my kids and their friends and so forth, but it's so fitting. I want to read my New York Post with the paper on my lap and a cup of coffee, in my hand on the train. On Saturday mornings, I go out to the local newsstand and I try to find my hard copy Barron's. It is just not a Saturday morning if I don't have that nasty ink stain on my fingers after a couple of hours of parsing the newspaper.
I was going to say, you don't mind having black ink on your fingers, obviously.
No, it's kind of my defining thing. My wife will say, you left a big smudge in the kitchen on the cabinet when you went to get to your most recent coffee pod. And it's true. Like my fingerprints are everywhere in our apartment from those nasty ink stains.
Definitely old school. I love it. All right, two more headlines I want to bat around with you before we get into the week's data dive. The first is a big headline. S2 Capital dissolved a $400 million first fund with no return of capital. What's your take on that?
Well, that is probably the biggest loss in what was a major story over the last 5 years. Many people know this story already, at least at a 50,000-foot level. I'll retell it here for those that don't. But in 2021 and 2022, during the ZIRP period, the zero interest rate policy period, we saw developers come out of the woodwork to use low interest rate loans to buy multifamily properties, usually for value add, and look to flip those properties within a couple of years. And they were expecting 20 and 30% returns. A lot of these developers were newbies. Newbies meaning they were people that were raising money, syndicators from other people, often in $250,000 to $1 million checks. So they would have dozens and dozens of limited partners. They would go out and buy properties and make promises of, we're going to buy this, we're going to put a couple of coats of paint on it, we're going to refurbish some apartments, and we're going to flip it within 3 years for a 20 or 25% return. And people lined up to write checks. One of those big syndicators was S2. They were led by Scott Everett. His S2 Capital, their first fund raised $400 million, and people will end up getting no money back on that. They will have written $400 million in checks for which they will get nothing back. Interestingly, and I believe this was all reported by The Real Deal, if I'm not mistaken, but interestingly, that fund is asking for another $100 million to try to salvage some return over the properties they still own. So not only are they asking people to swallow $0 returns, they're asking for more money in the process. Now, there were 3 mistakes that were made, 2 that were unfortunate, and 1 that was a incredible unforced error that led to this. And by no means was S2 the only one. There were dozens and dozens of syndicators that left their limited partners with enormous losses. Mistake number 1, buying properties at the peak of the market, right? Everybody flooded into the Southeast and Southwest. S2 was a big Dallas buyer, but they also bought in Georgia and North Carolina and South Carolina, many properties. The second thing is they assumed that they'd be able to bump up rents by 10 or 12% every year for the next 5 or 10 years. Silly assumption, especially when you consider that anytime you have that kind of rent growth, the market is going to be flooded with new inventory, and that's what happened in these markets. But the biggest problem of all, and there's a lot of hubris here to report on, was the use of floating rate debt. They used floating rate debt, many of these syndicators, and when rates went up, their borrowing costs surged. In some cases, they went up 200 to 300%, from maybe 4% to 10%, and that left no NOI, no free cash flow to operate these properties with. The irony here is S2 Capital's leader once made a remark that said, anybody who's using fixed rate debt is for losers. Here he is now a victim of his own hubris in that regard. So lots of sad outcomes here, but it's not a terrible surprise.
Yeah, definitely a hard lesson. What you referred to as the ZIRP strategy. I know we talked about Taylor Swift last week, and she's big into eras. ZIRP was that cheap money era, which to the point you made, it works beautifully when capital is cheap and rents are rising quickly, but rates are obviously much higher now. And a lot of these properties, insurance is higher, operating costs are higher, rent growth has slowed, and the math breaks quickly as it did here. I think it's certainly a tough pill for the investors to swallow, and I think it's a pretty hard ask to try to get $100 million to transfer viable assets into a new fund. You think he'll get it?
I think it's a hard sell, especially from people at the retail level. These
Yeah.
limited partners are really retail investors, once bitten, twice shy, I think. And I do think that there is that stigma that comes with losing this money, even at a more institutional level. It's funny, if you are a big player like a Brookfield or a Blackstone or a Simon or something like that, all of those entities have at one time or another suffered losses on properties. But if you have a long enough track record of success, you can avoid the stigma that comes with a loss. I think when you have losses of this size and you don't have that track record of success, it's a little harder to come back from. But we'll see. We are a country of redemptions and second chances and new chapters and so forth. So you never know. I'm a big redemption guy. I like to see people, come off the mat and rebound and punch their way out of these situations. I hope it happens.
Love it. You probably love the Shawshank Redemption movie.
Yeah, I'm a sucker for, the comeback stories. But we have to talk about Taylor Swift for a minute. I have to say, Diane,
You had a
I
big
was a very
week.
casual follower of the entire thing. I knew something was happening at Madison Square Garden. And, the news reports had people watching from outside and trying to see who was coming and going. But when I took my nasty New York Post and I got my, my fingers stained with it this weekend reading about what happened, I feel like I was the only guy not invited to this thing.
I know. I was going to ask you who you wore to the wedding.
I don't know. I felt like the doorman in my building and the guy I buy coffee with were at this thing. I was the only guy left out. What's going on here?
I'm absolutely amazed that they have revealed nothing to the media. Like, the media is so desperate to sink its teeth into something. And with all those people there, not a single person has leaked anything. And the media is just so desperate for it.
My wife and I had a long debate about this. She is a Taylor Swift fan. I have to say, I'm certainly not a Taylor Swift hater. My kids put on her music. I don't mind it. I don't go seeking it out, but I certainly have nothing against her success and her music and so forth. I think harmless, AM radio music, good for her. But that might change if this turns out to be a made-for-television wedding. If this is put on HBO and she gets a major paycheck for throwing all of this on Netflix or HBO, I might not have as positive a feel for her as I do today.
I'm with you there. I respected them for keeping it private, but all bets are off if they go in the other direction. And they might, we'll see. And Manus, I'm glad that you took that detour down Taylor Swift Avenue, because I was looking at the headlines that we have here, and some weeks they seem so positive, and this week it seemed like they were running more negative, and that you gave kind of a refreshing side conversation, because the last thing that I wanted to talk about was the building collapse in New York City. Former Pfizer headquarters at 235 East 42nd, in the midst of being converted from office to residential. What's your take on that?
Well, I'd say the first thing is it's an incredibly unusual event in New York and in commercial real estate in general. We've had Surfside, of course, in South Florida, that terrible tragedy with the condo collapsing a couple of years ago. But you normally don't see headlines like this in any major U.S. city, and certainly not in New York, where you have what appears to be an engineering/planning flaw, right? This isn't a case where the elevators are not operating or the HVAC has failed. You saw the images. These things look like folded elbows in a building. And for anybody that was in that building, I think it's terrifying. And I looked at the map. It's interesting. We have a great team here at EDR that looks at environmental, flooding, permitting, and so forth. And I asked their team to do a search of all permitting that's going on within a quarter mile, no, within an eighth of a mile of that event. And there's a lot of permitting. There's a lot of residential housing around there. I was reading headlines today that people were kicked out of hotels there because they thought that if this building collapses, there's no telling what happens. There's people who live in those neighborhoods that were told in the middle of the day, they had the fire department knocking on their doors saying, you have to get out, you have to evacuate. So this could be a problem that really knocks out several blocks of New York and creates an enormous inconvenience, if not worse.
Yeah, yeah. And I mean, we've talked a lot here about office-to-resi conversions, especially in New York City. And this is one of the biggest ones, roughly 1,600 planned apartments. And now in these projects, as we've talked about, they're complex. They're not like flipping a switch. And if they involve large, older towers, you have to worry about the impacts of added weight, structural limitations, even the order of operations for construction. So I think, probably more questions coming out of this about future projects and whether the assets can handle the redevelopment physically, financially, safely. Cynical side is I'm sure the blame game is well underway.
There'll be a lot of finger pointing here. The architect pointing to the engineer pointing to the construction company. I do think this will be very expensive, but I did look at the debt structure here, and there's a $720 million construction loan on this, which now is very much at risk. That certainly construction is going to stall. I don't know where insurance comes in this whole thing, but whatever lease up expectations you have are probably years and years out now. And that whole loan, I think, becomes under a lot of scrutiny. Some of it must have been drawn down already, I would imagine. So a lot to follow.
Yeah.
But to your point, in New York, we've seen an awful lot of office-to-resi announcements, and they've often come with financing in place. It'll be interesting to see over the next few months, does that dry up? People say, we're not lending on any of this stuff until we do a lot more due diligence on the building structure.
Yeah, that's what I was wondering too. And now will this address be stigmatized in some way, where potential renters will feel like it's unsafe? I will give you a fun fact, Manus, for the next time that you're at a New York baseball game or a networking event or a business dinner, and it's related. I saw it in the Wall Street Journal this week. The reporter was Lily Bell Polin, and she said that New York City built more apartments last year than it has in any year since 1965. And nationally, apartment construction has slowed to a 15-year low, but New York is at its first high since 1965. And even with all that construction, it still barely dents the housing shortage. So New York's metro needs 400,000 plus homes to meet demand. So even at last year's pace, it would take about a decade to close that gap.
Yes, I think my snarky remark will be, wake me when the median rent in New York City goes below $4,000, right? I think the last time we looked, I think the median rent was $4,600 a month, right? I think you have to build an awful lot of new apartments to move that needle meaningfully. So yeah, wake me up when we get below 4,000. Dianne, after our somewhat somber first 15 minutes talking about weak jobs reports, higher rates, and volatility in the markets, we're up to our data dive moment. Tell us what you have this week. Hopefully it's something less somber.
Dear Manus, I wish you didn't say that. I'm not sure this will perk people up, but I do want to get your thoughts on it. And it is the June CRE activity index. It came in at 119.9, and that was a drop from 129.3 in May. Set the index back to March levels. While the decline was relatively modest, what really struck me was that it was the first time this year that all three prongs of the index showed cracks, all by different degrees. But in the prior 5 months of 2026, one or two would go up, one or two could go down. But this time in June, all three pulled back a bit from May. Environmental due diligence came down only by 1%, but that broke a 4-month streak of increases. Property listings were down by 6%. That was the second month of modest declines. But really the most pronounced was on the lender-driven appraisal sector. That was down by 20%. And that was after a strong 8% uptick in May. So a bit of a head scratcher. They were really all over the place. And I'll close with this, Manus, and then I want to get your reactions. 1 month obviously doesn't make a trend. And we can, I think, take solace in the fact that the index is still firmly in triple-digit territory for the 6th month in a row. So, we will have to see what July shows, but maybe the war and all of these metrics that are all over the place is starting to take a toll.
It's interesting. If we go back to March and April, I think we were surprised at the spryness of the market and even more surprised that those numbers held in May so high. I think we were holding our breath thinking that a bump in the road was going to happen. And I look at these numbers here and I wonder, is this the bump in the road, number one, or is this, as you mentioned, just a blip, right? We don't know. But it's disappointing that this dip comes at a time where we're seeing a lot more noise geopolitically, in interest rates, more volatility, that I would feel better without this blip, with all the noise we've heard in the markets this week, than this noise coming after seeing this decline.
Right, right. And that, I think July will be very telling in terms of whether this was just a temporary reaction or something, something more deep-seated, something more lasting.
Yes. I mean, people know I do try to call it like I see it, but for the last 3 months, the way I've been seeing it has been very positive. This doesn't feel nearly as positive as where we were a month ago. And ironically, it comes after what I thought was a great weekend for our country. That I came out of this weekend watching the great fireworks from so many different locales throughout the United States. The stuff in New York was just incredible. I saw it on television, but it was amazing. So many people taking to the streets to watch this stuff. The big ships I got to see in person, the flyovers and so forth. And there seemed to be a little bit of nostalgia and a little bit of putting the current antipathy and resentment we have for each other between right and left behind us for a short period of time. I came out of the weekend very hopeful, but it didn't take long for the markets to set me back into reality.
The hopefulness, the unity were, and the fireworks were incredible. I love New York City's fireworks, but then I watched Boston's, and I got to go Boston for the win. And the reason is because they had a phenomenal drone light show that brought up images from the Revolutionary War, and it was just like mesmerizing. So if you haven't seen it, go on YouTube and find that.
Well, I'll take a detour here very quickly. I did something very spur of the moment on Saturday morning. Even though it was like 99 degrees with incredible humidity, I managed to talk my wife into taking a short road trip. When we're in New York, we normally stay in southern Westchester, which is only about 15 minutes from the George Washington Bridge. For those that don't know, in New York, you could actually walk across the George Washington Bridge. There are pedestrian paths on the north side and the south side, and you see bikers going by all the time, people riding their 10 speeds, walkers, and so forth. It's very easy to get to. So we drove our 15 minutes. We parked on Broadway in Washington Heights. We walked 10 minutes and we were able to walk out to the middle of the bridge, which for those of you that are afraid of heights, this is not hard. You're really quite contained. The fences are really high. The bridge isn't shaking at all. So if this is giving you edginess, just even hearing about it, I'm not somebody who loves heights, so it was easy peasy going out there. It was a really nice breeze, which made the day great. But we were able to see dozens and dozens of flyovers, which was just so cool. These, 10 military planes in formation in that triangle, zipping barely above the bridge itself. And then the big ships coming by and turning around right at the base of the bridge was just an incredible thrill for a couple of hours Saturday. So Dianne, if you're still around, I plan to be at our tricentennial anniversary. We should try this.
I will keep that in mind if I remember it. When that, I love it. Well, that's a nice segue to the week's Did You Know? You talked about the 4th of July and the festivities and the camaraderie around that. The World Cup games are another example that's bringing us all together. Great USA team this year. So for the Did You Know, I looked at the 11 US cities that hosted World Cup games. And among those 11, the 3 that had the strongest activity and Lightbox data at mid-year over last year represented 3 really different regions of the U.S., which I thought was interesting. Number 1 was San Francisco, activities up mid-year 18%. Kansas City was number 2, up 14%. And rounding out the top 3, Miami is up by 13%. So 3 very, very different high-growth markets, all hosting World Cup games.
The World Cup itself was, in addition to providing this great economic jolt to all these cities that you're mentioning, the restaurant owners, the bar owners, the hotel owners, all seeing great activity in their cities. It was another feel-good moment for me over the last 3 weeks. I'm not an enormous soccer fan, but I found myself watching games even that had no impact on the U.S. squad at all, watching, teams from the various continents play. I thought the fanhood was incredible, right? There's been no drama. There's been no fist fights. There's no drunken behavior, at least not that you see on the streets or in the stadiums. It has been one feel-good moment after another. Certainly, the loss by the U.S. was disappointing the other night, but I've just been so happy. So many of these cities have been left barren by work from home. It's been a tough couple of years. Seeing the streets of Seattle flooded with fans and Miami and New York City, and seeing those Norway fans, the Norwegians, doing that rowing, it's just wonderful. It's been a great feel-good month for humanity, from my point of view.
I agree. And it's almost more fun to watch the fans than it is the game, just to see the face painting and the costumes and the energy, and having us as a host country, seeing others come here and what they kind of gravitate toward. I kept seeing headlines, Manus, about how popular Waffle House was, and apparently ranch dressing is something that they're not familiar with, that they're trying to bring back to their home country.
Well, my kids always remind me it's only a few letters to be moved around to change Waffle House to Awful House. But if the Europeans like it, good for them.
Yeah, exactly. All right, let's switch gears and talk about the deals that caught your eye this week. I know you have a lot on the development front, so let's start there.
Yes, we've been so negative, or reporting negative information so far, between S2 capital, higher interest rates, the activity index being on the downdrift this month. Let's talk about a couple of good things that we saw this week. I'll start out actually in the sales side, and then I'll go into the development side, if that's okay with you. On the sales side, I'll start with two land sales. The first one, I believe this comes from The Real Deal, Lennar and TPG picking up a development site in Saratoga, California, not Saratoga, New York, for $110 million. The duo bought a vineyard in that area for $110 million, where they expect to develop single-family homes. We love that. This country needs more homes. We have several million fewer homes than we need. Lennar doubled down on that in California by buying a Bishop Ranch office building, which they expect to raise and build hundreds of homes in that area as well. So if I'm not mistaken, the price tag on that second one, $156 million, where new housing will be developed in Bishop Ridge. I will give two more positive headlines. In Chicago, PGIM, taking advantage of the strength of the Chicago market that we've talked about so frequently over the last 2 months, they are selling the Sono East apartments for $125 million. The buyer there, RPM Living, they paid $125 for the 324-unit high-rise property. Here, PGIM making a nice profit. They bought the property in 2005 for $105 million. So cashing out with a $20 million profit there. And lastly, in Phoenix, a record-breaking sale. Cavan Companies sold the bungalows on Camelback for $112 million. This is a build-to-rent property, and it represents the highest build-to-rent sale in that region ever. So after a lot of negativity in the first 30 minutes of this podcast, coming right at you in your zip code, Dianne, with 4 good stories.
Way to swing the needle back in the positive. The Phoenix story is interesting because you mentioned that it was ranked as one of the state's largest build-to-rent trades of the year, but Phoenix's multifamily sales volume is down from last year. They had, in the first half of the year, 1.6 billion trading versus 1.9 billion a year earlier. But here you've got them really jumping into the build-to-rent sector, which is great to see. And the other thing that I read that I thought was interesting on the Bishop Ranch story is Lennar's building 255 single-family homes on those 25 acres and replacing 3 existing office buildings. And Bishop Ranch is a whole area that's going from kind of like fewer isolated office campuses into these integrated neighborhoods that have parks and trails and new housing and amenities. It's like they're building a new city from the ground up. It's really interesting.
We need it, to be sure. This has been a long time coming. This housing shortage is real. And whether it's multifamily housing in New York or single-family homes in California, we need this, right? We are under-homed and under-rental united in many areas, including New York.
Yeah, for sure. And I always like when stories bring in kind of a sense of community instead of just building 100-plus houses with nothing really to support that. Great to see. All right, Manus, let's switch gears and jump into the development stories. What do you have?
Again, I'm going to try to stick to the upbeat category. The first one in Brooklyn, Landau Properties putting shovels in the ground to start a $550 million residential project in Brooklyn. We love that. More development on the way in the housing segment for New York. I believe this is Brooklyn Heights, which is right over the Brooklyn Bridge, the closest part of Brooklyn to New York City. Affinius Capital made a $180 million loan for a New Jersey City multifamily tower. This is reporting from Brian Paskus of Commercial Observer. Namdar here, continuing its expansion of Journal Square in Jersey City, this particular property at 35 Cottage Street. Why bring up that particular property? The Namdar name caught my attention. Namdar was a bottom fisher in the mall space for a long time, buying malls at 80 and 90% off for years and years. They have since bought into buying discounts, big, highly discounted office properties. They've done a couple of those in the last couple of years. And now here, expanding once again into multifamily development. So good on them. In Metro St. Louis, Lifetime and Midas Hospitality looking to open a 260-unit apartment complex there. Why bring up that story? Metro St. Louis, one of the worst hit areas for quality of life issues and office value degradation over the last 5 years. Nice to see a pair of developers come back and try to revitalize that particular area. And lastly, in Kansas City, Millhouse. Hard to think of Millhouse without thinking about The Simpsons, but Millhouse will build a 194-unit affordable housing project in Kansas City. So 4 good stories. I love these types of stories because it shows there's ongoing appetite to put shovels in the ground and put money to work.
Yeah, for sure. And I have to thank you for those last two, St. Louis and Kansas City. I'm heading next week to see a client in Indianapolis. So that gives me some good stories to put in that region as a way to show that there's growth happening. And like you said, the optimism behind putting shovels in the ground. So thanks for those, Manus.
Invesco, they landed a $42 million lease in the Inland Empire with an auto parts distributor. Big number there. We had reported in the past that there had been a little bit of softening in that Inland Empire leasing momentum. Invesco here nailing a $42 million industrial lease, which is real money by any standard, $42 million. And a Palo Alto, GM, taking a 340,000 square foot lease in the Stanford Research Park. Harvest and TPG agreed to spend millions on a build out there. GM with nearly 350,000 square feet of new leasing in Northern California. So I think we've turned the corner here, Diane. We took what was a very downbeat podcast and we at least evened it out.
I love ending on a high note. Let's do a slice of life that'll make everybody smile. Tell me what your best soccer memory is. We'll stay in keeping with the World Cup theme.
Wow, that's interesting. I was never much of a soccer player, never really played on a team. Would do 5 days of gym class every year from kindergarten until about 6th grade. And that was it. But my son and I, my youngest son, and I took a service trip to Peru 10 years ago, and we got to play against some of the locals. My son is a very good player, and a couple of kids in his high school were on the trip as well. They were able to keep up with some of these 14 and 15-year-old Peruvian players who were terrific. The old geezer in me was proud just to not have to reach for the oxygen mask, but it was a thrill to just meet people from a different culture, to get out there and run around, to see smiles on the faces of people that couldn't communicate with one another, but could compete and shake hands at the end and really have a great time in Lima for 2 or 3 hours.
Yeah, that's so great. That's so great. I was in London a couple years ago with my son, and the UK team was playing, I think, Denmark, and it was a Thursday afternoon, 2 p.m., and I thought, oh, well, we'll go into a pub. It'll be the first time that he sees a real soccer game. Business day, 2 p.m. It was standing room only in this little tiny pub. All these, even business people, like everybody was crammed in there shoulder to shoulder to watch this game, and it got loud and it was boisterous. It ended in a tie. 1-1, all of a sudden the game was over and everybody just disappeared. The whole place emptied out while everybody went back to work. I've never seen anything like it.
Is it true that you got a crowd surf in during the afternoon, Diane, as part of the event?
I did not. I did not. And nobody had their face painted either. Very subdued there, but they were very enthusiastic about their team. That was really fun to see.
Great stuff.
Yeah. All right. Well, thank you to our producers at Bruning Media. Be sure to join us next week as Manus and I drill down into the news headlines, deals, and developments of the week. You can listen on all of your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you all for listening and have a great weekend.
Let's go.